In the meantime, here come the big bank earnings. JP Morgan, Wells Fargo, and Citi are going to kick things off on Friday. That will be followed by another wave next week. This sector has been on a tear lately. It's been outperforming the broader market over the last 2 weeks. Of course, that's been as interest rates have continued to climb. Joining us right now with her expectations for the sector is Betsy Gracek. She is Global Head of Banks and Diversified Finance Research at Morgan Stanley. And Betsy, when we start looking at these actual earnings numbers, that's when the rubber really hits the road. Expectations have been fairly low. Where do you think the banks will come in once they start showing us how they performed last quarter?
So for earnings, thanks so much, Becky, for having me on the show this morning. Regarding bank earnings, we are optimistic on bank earnings. We think that, for the most part, banks will beat consensus estimates. And that's for 3 reasons. We've got credit doing better. We've got an outlook for rates to be improving. And we also think we're going to see some action on expenses and messages about expenses for 2021 for expenses to be under control.
I guess the other big part of this, the other big part of the reason for these stocks really being on a roll is the idea that there will be additional stimulus that comes out and what that will mean to the overall economy. Of course, the banks have a lot riding on how consumers are doing and how businesses are doing. How do you game this out in terms of where the stocks have run so far and what you think it's worth?
Well, it's a great question. And when you think about the stimulus, first of all, what it has already delivered is much, much, much lower credit costs than anyone would have expected, given the level of unemployment, even that we have today at 6.7%. So when we think about another level of stimulus coming in here and, effectively coming in right now, what it says to me is my peak net charge-off estimates that are currently in my model for, the end of this year could be too high. I might have to bring those down. And when you bring down those losses, you also are able to release reserves faster and drive more buybacks. So as we go through this earnings season kicking off Friday, like you mentioned, that's going to be a key question for managements. How much does this extra stimulus give you in terms of less expectation for credit losses? It really reduces the risk in the book.
A Walmart executive spoke yesterday at the National Retail Federation and said some things that are kind of concerning. She talked about how when they surveyed their customers, more than 40% of them don't see any turn in the economy, at least from their perspective, for quite some time. She mentioned that a lot of Walmart shoppers have been doing things like trading down. You go from a national brand to a private label brand, and maybe you buy a smaller box of something than you'd been buying before. And also said that obviously Walmart customers might be a little bit disproportionately at risk versus the broader consumer. But it does raise questions about who's tied into that, what businesses, what banks. I guess I wonder what you think of those comments and as a result of everything we're seeing, which banks you like best.
So in terms of that, consumer outlook, I think, so number one, part of our expectation is that as we get the vaccine fully distributed into this country, that we, bring back to life some of those sectors that are, under ice right now. And so hopefully that consumer sentiment will improve over time. I'd say the second thing is that you get that incremental stimulus check in your pocket. That's going to help out for at least another several months. So you put those 2 things together, and we do think the outlook is positive. When I think about my sector going into this earnings, we do have 3 top picks. It is Synchrony, Amex, and State Street. They're very different. Synchrony, one of those stocks that is more consumer-oriented, clearly as a private label credit card and consumer finance lender. Why do we have such a positive view on them? They have already reserved for significantly higher unemployment levels than we have today. And the group overall has a reserve level of 7 to 9% unemployment year-end 21. We're below that today. So these companies are sitting on excess capital, excess reserves, excess liquidity, and I think my stocks can afford any, coming stress that's likely to happen as we exit this pandemic. For Amex, it's really a call on reopening travel, and that we do expect is going to be accelerating as we go in the back half of this year. And then State Street is a way to play rising rates and lower expenses.
Shepard Smith here. Thanks for watching CNBC on YouTube.